to 4G, I can do something about it if I can. So the 5-step approach for revenue recognition. Let me simplify it for you here so that you won't think it's complicated. The revenue recognition principle is still the same. I mean, we have to recognize revenue, to record revenue when we earn it. What do we mean by earning it? When we deliver the goods to the customer and he, she accepts it, or when we provide the customer with the service. That's it. However, there are cases where this straightforward application will not do any good. So we're going to see why. We're going to see, or you may ask, why do we have to use this 5-step approach? It's not going to be used every time. It's going to be used mainly in the cases where there are conditions that should be fulfilled first before you earn the revenue, and accordingly you go and book it. So actually we're seeing special cases in the revenue recognition principle that give rise to the need for this 5-step approach. Okay, so you know this. There are a lot of slides that I will either skip or go over them very quickly because they are qualitative, or they include basic information or repetitive information that has been said before. So revenue recognition occurs when we satisfy the performance of an obligation. Okay, this is what I meant when I said we earn the revenue, or we either by delivering the good or the service to the customer. Of course, revenue should be recognized at an amount that reflects the expected consideration, the price. So we have to have an agreement on the price. Of course, otherwise, if one of the two parties do not agree to the price, the deal will be out. So there will be no sale, no revenue. So the price has been agreed on. We delivered the good or the service. The customer accepted the good or a service. So you ask me to send you 5 T-shirts, yellow, small. I sent you 5 red, large. There is no revenue because you're going to return them most likely. And of course, all entities should abide by this revenue recognition principle. There are other standards when it comes to contracts such as leases, insurance, non-warranty guarantees, financial instruments. You're going to cover these in other chapters in the financial accounting and reporting part. Why the 5-step approach? Because it contains 5 steps. And the mnemonic to remember the 5 steps is I'm star, I'm a star, okay? I star, or I'm a star. What are these 5 steps? We're going to go over them quickly. Don't worry much about memorizing these. Just have an idea about them. It makes sense, actually, when we go over them, it will make sense to you. I would prefer to focus on the examples. If you know how to provide or to solve an example, you know how to write the steps then in your way or in your words. So what are the 5 steps? Step 1, to identify the contract, okay, between the seller and the buyer with the customer. 2, what are the separate performance obligations? Very important, because we're going to recognize revenue when we satisfy those obligations, when we do what we promised to do. So first, we need to know what are our obligations and whether they are separate or one single obligation. Step 3, determine the price. I just mentioned that. 4, allocate the transaction price to the separate performance obligations in case you're selling 5 things that either can be sold in one bulk or 5 separate things. Of course, if you sell them in one bulk, you will give the customer a discount. So if you sell 5 things with each other, it would be, let's say, for $100. If you sell them one by one, they will add up to be $115. So how are we going to distinguish, or how are we going to allocate the revenue of the $100 bulk over the 5 products? We're going to see this, don't worry. Step 5, recognize revenue when or as the entity satisfies each performance obligation. Okay, so this will not make much sense until you see examples. I promise you we have examples. What's next is, over the coming few slides, is an explanation mainly about, or an explanation of the 5 steps. So identify the contract. Of course, the contract, probably you don't know this, it can be verbal, written, or implied through the, the relationship between the two parties. And you will cover this in more depth in the regulation part, where you have a contract between two parties. Yes, it can be verbal, it can be written, it can also be implied through action. So let me give you an example about this implied. If I see a person selling sandwiches in a small, wooden cart, and the next day I see another one selling the sandwiches. Then the third day, the first one again. The fourth day, the second one. So they are alternating. So I can assume that these two guys have a contract between them to operate this sandwich cart or small, shop, or whatever you can call it. So it's implied that the way they are conducting or the way they are behaving indicates to a reasonable person that they are conducting business together. Okay, so that's for implied. Yes, of course, it can be verbal, it can be in writing. Just know this. Criteria for identifying the contract. The 5-step approach is applied only when a contract with a customer meets all the following criteria. Go over them. I will go over some of them, and then we will move. All parties have approved the contract. Yes, of course, if one of the two parties does not approve the contract, thank you. We're done. Rights of each party are identified. So it should be clear in the contract. What am I going to deliver? What are you going to give me in return? Payment terms, I just mentioned that. Contract has commercial substance, because if it lacks commercial substance, the accounting differs. You will learn this in another chapter. So it has to have commercial substance, meaning future cash flows will change as a result of this transaction. It is probable that the entity will collect substantially all of the consideration. Again, because if I have doubts about the ability of the second person to pay me, then another accounting treatment would be applied. The installment sales method or the cost recovery method, not the revenue recognition principle as we know it. So if I'm selling someone on an installment basis and I expect him or her to pay me over 5 years, I know they are liquid now, but how can I tell whether they will still be liquid 2, 3, 4 years from now? So to be conservative, then you have to go into another method, the installment sales method, the cost recovery method, which is more conservative. Again, you will learn this in other chapters.
What do we
Yes,
mean
please.
by, yes, thank you. What do we mean by changing in cash flow?
That the position of the company will change regarding or as a result of this transaction. So cash flows and the amount, the risk, the timing will change. This is what they mean. Okay. Because if it lacks commercial substance, then there is no cash transacted. Another story will pop up. We will see this later on. So there should be some commercial substance. There should be cash or other consideration exchanged. Okay, this is what we mean by the future cash flows. Let me give you another example. If I buy something from you, yes, it is expected that if I buy inventory from you, I will resell this inventory. So there will be a cash inflow on my side from the selling of this inventory. So there would be a future cash flow from this. Okay. It does not have to be necessarily directly future cash flow, but the position of the company, you will be in a better position as time passes as a result of this exchange. This is what we mean usually by having commercial substance. Okay, Sindus, is it okay?
Yes.
Sindus, great, great. What's this at the bottom? Do you remember when do we record this entry without reading up there? What's unearned revenue? Can you help me with that? Come on.
Is it
Yes.
a revenue that we have, let's say, ship or we delivered the revenue, but we didn't recognize or collect the revenue itself. So, isn't it?
It's the other way around, Abdul Jabbar.
Yani
the
we
other way
accept
around.
the revenue. We accept the revenue, but we didn't give the service yet.
So, can you repeat? Did you give the revenue? I didn't hear it.
The cash is collected, but the service is not yet delivered, or the goods are not yet delivered.
That's excellent. Thank you, Muhammad. Thank you, Muhammad. Thank you for your input, all of you. But I didn't hear some of your input. Ladies and gentlemen, remember, an unearned revenue is not a revenue. Let's start from here. It's not revenue. This is why it attracted my attention when I heard it's revenue. No, it's not revenue. It's unearned revenue. It's unearned revenue. It's a liability. Actually, remember that this is a liability account. It should be presented in the company's balance sheet under liabilities. And when will this account come into the scene? When, yes, as Muhammad said perfectly, when you receive cash before you deliver the service to the client. So a client comes to you, he says, I want you to send me 100 boxes of photocopying paper, and this is $300 advance payment. So I would debit cash, of course, but I did not send her the boxes yet. This is unearned revenue. Once the boxes are there and she accepted it, yes, I will prepare an adjusting entry whereby, and we're going to see this later today, we convert the liability to a revenue by debiting unearned, crediting revenue earned. Remember this. Then there are some slides talking about combination of contracts, when to combine two services in one, or when to deal with two delivery of services in two separate contracts. So again, it's self-explanatory. I would prefer to leave it to you. I will skip it pretty clear as I'm doing. Modification of the contract. Yes, you may modify the contract if the two parties accept. And yes, you can treat it as a new contract or as a modification to the existing contract. Not a big deal. And there are some examples as to how or when to include this as a modification. Okay, sometimes look at this example. We're going to see an example. The scope increases due to the addition of distinct goods or services. So I am building for you a two-story house structure, and then you ask me to add a third one. That's clear that the third one is a separate thing from the other two. So we can merge it, we can modify the contract, or we can have a separate contract regarding the third story, the third floor. Step 2, identify the separate performance obligations. This is very important. Are we going to, would it be clear as to what we are going to do? Is it separate or it is one obligation? Okay, we're going to see examples. Don't worry if it's not very clear what we're talking about here. It's normal. Let's see the examples to come. We have great examples ahead of us. In order to be distinct, promise to transfer, not a big deal. Separately identifiable, interesting stuff. A transfer of a good or service is separately identifiable, like the example I just told you, if the entity does not integrate the goods or services with other goods or services in the contract. So it's something that I can treat it aside. It's not integrated. So how can they be integrated? They have a great example to come. If I am building an apartment for you, yes, I will be doing the electrical wiring, the piping for the sewage. I will be painting. I will be constructing the walls, the whatever. These are separate, but can I deal with them separately? Can I sell you the apartment without electrical wiring or sewage installation? Doesn't make sense. So it goes without saying that these are all included in the bargain. So they are not separate performances or obligations, although, yes, they are separate, but I cannot sell them alone. I mean, they have to be integrated. We're going to see good examples about this. Not separately identifiable, we're going to see examples. I prefer to go to the examples to spend more time giving you examples, solving MCQs, showing videos, rather than going into dry qualitative stuff. Please do not misunderstand me. I'm not skipping these or going quickly here because they are not important. Definitely not. They are very important, but I mean, with the time limitations we have, I can rely on you that you can go over these, and I'm responsible for answering anything later on about these, don't worry. But I prefer to spend more time on the areas where, in my opinion, you need support, you need the examples to put things into perspective. Let's start with those examples that I promised you to see. So this is an example. They will be asking, always read the requirement first. Identify the performance obligation or obligations in this contract. Let's read. Tanner Company is building a multi-unit residential complex. The entity enters into a contract with a customer for a specific unit, an apartment, that is under construction. The goods and services to be provided in the contract include procurement, construction, piping, wiring, installation of equipment, and finishing. I just gave you this example. What do you think? Is this a single performance obligation or a multiple performance obligation?
Single.
And of course, because you cannot sell each part alone. Look at the explanation on the right. Although the goods and services provided are capable of being distinct, we're counting them. They are not distinct in this contract because the goods and services cannot be separately identified from the promise to construct the unit. Yes, in another contract, someone may get me to do an overhauling to the wiring of the apartment. That's different. But here I'm constructing the apartment. It makes sense that while constructing the apartment, it would include the piping, the electrical wiring, the finishing, so on and so forth. The contractor will integrate the goods and services into the unit, so all the goods and services are accounted for as a single performance obligation, so you don't have any revenue until you give him the key or her the key, until the job is done. Okay, that's common sense. We will see the other side of the story. Look at this. Don't look at the solution. By the way, I always wanted to ask this question. Now, can you see the solution, or you exactly see my screen with me at the top and your names below me? So is this rectangle here hidden from you, or you can see it as I'm seeing it?
It's visible. Yeah.
It is visible. So I'm hiding the solution. Okay.
We can see the
Look
solution.
at the fact. Still, you can see the solution, part of it, not all of it.
Until technical support.
Okay. Okay, great. But I wanted really to see whether you see exactly what I see, or this block here, the black box in which I am presented along with your names, is hidden from you.
No, it's in the
Okay.
corner. That's fine.
Okay, great. Thank you. Look at the facts. A software developer enters into a contract. Again, what's the requirement? Identify the performance obligation. What are your performance obligations? Is it one or separate or single? A software developer enters into a contract with a customer to transfer a software license, perform installation, and provide software updates and technical support for 5 years. The developer sells the license, installation, updates, and technical support separately. That's a different story than the first example. So I am a computer shop. Yes, I can sell the license, I can sell a maintenance contract. I can do the updates. I can do the installation for 4 different persons, different clients. The entity determines that each good or service is separately identifiable because the installation does not modify the software, and the software is functional without the updates and technical support. It might be a pain in the neck not to engage myself with the company to do the updates and the technical support, but this is my choice. I don't want to do me any updates. I don't want you to come and solve any problems that may pop up. So this might happen. Of course, this is not healthy to do it, but this is it. In this case, no, it is not a single contract. It's not a single obligation. So the software is delivered before the installation, the license. Then you do the installations, you do the updates, you do the technical support, and all can be done without the rest. So the developer has also determined that the software installation are separately identifiable. So they are giving me the answer. On this basis, there are 4 performance obligations in this contract, and we will see a numerical example as to how to allocate those to each one in case I am giving the customer a discount if she purchases the whole package of the 4 obligations. Okay, we will see a numerical example. Determine the transaction price. The easiest, I would say, it should be very clear what's the transaction price, and it can be in many terms, I would say. But of course, we have to look at whether it is variable consideration. Is there any clause in the contract that allows me to change the price within a certain percentage? Let's say if the concrete price or the steel price in the market increases, significant financing, I have to record my revenue based on the time value of money in case I'm giving the customer the option to sell on an installment basis, short installments. So I have to bring back the future amounts to the present value. Again, we're going to see a good example. Non-cash considerations. Okay, I may sell something and the customer will pay me in inventory. So I will sell them inventory, they will sell me a fixed asset, or vice versa, or a combination of cash and other. And of course, sometimes you sell the customer and you give him her discounts in the form of future discounts, coupon, or something like that. This need to be deducted from the revenue. Remember, we're talking about revenue recognition. So all of these should be always be in your mind as to how much is the revenue to be recorded. I've just mentioned a couple of words on each one. Let's go into examples. Financing, non-cash considerations. Okay, that's a good example. Again, let me try to hide to a great extent the solution. Okay, so that we can I can actually to promote thinking and to be with me. Look at this. This is interesting. On Jan 1, year 5, SDF sold furniture to a customer for $4,000 with 3 years interest-free credit. Okay, the customer took delivery of the furniture on that day. So I have the obligation to record revenue as per the revenue recognition principle when we deliver the goods. However, will I get paid on this date 4,000? No. The customer will pay me over 3 years? Yes. So I need to record revenue based on the present value of the future payments. So I need more information, obviously. The 4,000 is payable to SDF on December 31, year 7. So no installments. The guy or the lady will pay me in year 7. Okay, so January 1, year 5. So year 5, year 6, year 7. So I'm giving you the furniture today, but you're going to pay me 3 years from now and no interest. No interest does not mean that there is no present value to this future 4,000 after 3 years. So you need to discount the 4,000 back to its present value now. I need the discount rate. It should be given, of course. The applicable discount rate based on the customer's credit profile is 8%. Determine the transaction price for the sale of furniture. So that's a finance example. We're going to discount the 4,000 back to its present value by applying the formula. If you don't remember it, this is the formula. So 4,000 times 1 divided by 1.08. 1.08 is the 1 plus the rate, which is 8%, to the power number of periods, 3. So remember the formula. So it's the future value, the amount I expect to receive after 3 years, times 1 divided by 1 plus the discount rate to the power number of periods, in this case 3. So if you do the calculations, you will get 3,175. So revenue should be recorded as 3,175. And I should book it now. The remaining, how much, 825 is what? This is interest revenue. This is not sales revenue, I mean. This is an interest that I expect to collect over the passage of time. So interest income, interest revenue will be recognized each year on a compounded basis. So year 5, okay, the first year is 3,175 times 8%. Year 6, it is 3,175 plus the interest of year 5 times 8%, and year 7 times interest of year 5 and year 6. So that's the compounded interest. Entry-wise, can you help me with the entry before I show you the entry on the following slide? What would be the journal entry this company should record on Jan 1, year 5, when we sold the furniture? Yes, Abed.
Debits accounts receivable, credits revenue
How much? How
for
much?
3,175.
Great. And revenue 3,175.
Uh,
And we need also to prepare an entry to record interest income at the end of each year. Okay.
yes, okay.
So where's the entry? That's slide number 24, 25. Where's the entry? So we prepared the entry. Okay. So we have to debit accounts receivable for, you can merge actually the 3. Okay. You can merge the 3. I would say you can debit accounts receivable for 4,000, revenue for 3,175, and I would say unearned revenue for the remaining. Okay, unearned revenue, because on January 1 you do not earn any interest yet. Okay, so that's probably a better entry. Or what Abdel Fattah said is no problem, but we have to remember that we expect to collect 4,000. So your accounts receivable should be for 4,000. Your revenue is 3,175, and you have unearned revenue of how much of the interest. Okay, and this interest at the end of year 1, the 254, you will debit the deferred revenue, the unearned interest revenue, and you credit interest revenue earned or interest earned or whatever. Okay, so that would be the entry. Okay, any questions? Are you okay with that? For some reason, I remember I've seen the entry probably in another example and I mixed up. I don't. Any questions about this? Yes, probably in this example. Step 4, we agreed on the price in step 3. Step 4, what if it is a bulk sale? How are we going to allocate the transaction price to the performance obligations? Okay, if they are multiple. Again, we have two cases here. Is it a standalone selling price? I mean, if you purchase the 4 things together, you will get a hidden discount. And I gave you an example of that when I told you if you purchase 4 things for 400, that would be a discounted price. If you purchase them alone, you will pay 115, let's say. So it's always important, again, to see this. And if the customer is purchasing the bulk purchase, we have to allocate to each product how much it's going to be allocated in revenue. Let's see transaction price changes. We covered that somehow. If the price changes, again, you have to, and you allocated the price, the old price to the 4 products. If the price changes, you have to do it on a pro rata basis. The change should be allocated to the 4 parts using the percentages you used in your first allocation. So it is common sense, I would say. Let's see this example. This is another example, again, that again will make it clear. A software company enters into a $250,000 contract with a customer to transfer, look at this, the software license, perform installation service, and provide technical support for a 3-year period. So we have 3 things. The entity sells the license, installation service, and support separately. That's very important. The software license is usually sold for $160. Start computing with me, $160. The installation service is $20, that's $180. Technical support runs $30 per year. For 3 years, that's $90. So $90 and $180, $270. So if I'm going to sell all of the 3 items together, it would be for $270. How much am I charging the customer? $250. This is what I talked about a couple of times earlier today. If I'm going to sell the 3 products alone, I will generate $270. The customer says, I want them all. So obviously, when you purchase something in bulk, I mean, in that's what we call quantity discount in inventory terms, quantity discount. So I'm selling the whole 3 items. I'm giving a hidden discount of $20,000. The installation service and technical support can be performed by other entities and the software remains functional. So they are, again, telling me that they are separate and they can be sold alone. The contract price must be paid on the installation of the software, which is planned for March 1, year 1. How should the software company recognize revenue for these transactions? So, how much I'm going to be paid? The contract price must be paid on installation of the software, which is planned March 1. So I expect to receive $250 on March 1. So I would debit $250 for cash. I would say this. Of course, this is the 170 or the 270 I tried to calculate with you. Okay, so the 160 plus 20 plus 3 years of maintenance for 30,000 a year, that's 90, that's 270. I'm selling it for 250. So the entry, first, let us think logically, how am I going to allocate the total revenue of 250 to the 3 products? And logically, what do you think is a good way to do it? Can you help me with that? Logically.
Pro rata basis.
Someone is speaking, but the voice is too low.
On pro rata basis.
Yes, Ribal, thank you. Yes, it is on a pro rata basis using the overall 270,000 number as my, denominator. So how much am I going to collect? 250. How much of the 250 will go to the software license? How much is the selling price of the software license alone? It's 160. So 160 divided by 270, that's the on pro rata basis that Ribal suggested, times the 250. The installation service, it's 20,000 for 270. Okay, so 20 by 270, that's the ratio of the installation service out of the total 270 times 250, and the same applies to the technical support. Now, remember that I need to receive the 250 on this date. So I'm going to debit the accounts receivable. Sorry, I'm going to debit cash for 250, but I don't have revenue of 250. Okay, I have revenue for how much? For the first two. Why? Because I didn't provide on this date, March 1, any technical support yet. The technical support is very similar to any other service or any expense that will be incurred as time passes, like interest expense. So I need to wait until I earn this revenue. Now we have unearned revenue. So the 250 is for these three items. The first two items are revenues. So I should expect revenue. But the remaining 83,333 should be unearned revenue. And yes, this is how you're going to prepare the entry. So debit cash for 250. The two revenues for the license and the service are credited to revenue because you earn them. However, the 83, which is part of the 250, is unearned revenue because, as I said, on March 1, you did not provide any technical support yet. So what do you expect that this company would do by the end of the year, after 10 months have passed?
Revenue, we will record service revenue for 27777 for year
From
one.
where did you get the 2777?
Year one multiply by 3.
Exactly, divided by 12 times 10, you mean?
Yeah.
Because in year one, we have provided them with a service for 10 months, okay? March through December. So 10 months. So it's 30,000 per year. It's not 30,000 per 10 months. So at the end of year one, we're going to, that's the number I think you mentioned,
Yes.
20 or
It was 10 months, not a year.
Yes, that's the 3 month, the 10 month. So
Yes.
from where did we get the 2,314? Remember, it's 30,000 per what? Per 12 months. So if we divide 30,000 by 12, 2,500. So the unearned revenue on a monthly basis, they are computing here or they are assuming the company prepares adjusting entries monthly. Let me put my camera off because my internet is not stable. So it is how much? Let me go back to the calculations. How much is my earned revenue? Let's go back to this entry, 83,333. Okay, 83,333 is for how long? For 3 years, for 36 months. So it is 23,148.8. Yes, that's exactly the number. So the 2314.8 is nothing but dividing the 83,000, sorry, the 83,333 unearned revenue, okay, by 36 months, making up the 3 year over which you're going to perform the the, what do we call it? The service, the maintenance service, support service, whatever. So every year or every month, assuming the company prepares adjusting entries monthly, on March 1, this is the entry you should prepare. Okay, so this multiplied by 10 months, this is the amount of earned revenue that should be converted from 83,333 unearned to earned revenue. So don't get confused. On the right here, they are talking about it in the first year, 10 months. In the entry, we are assuming the entry is prepared monthly. Okay, so not a big deal. Please, do you have any questions here before we continue? Any questions? All is crystal clear. Don't let anything not be highly clear. I told you last time, don't expect the bulb to light in class, but this does not mean that it's okay to be completely lost. No, there's something wrong. So if you're 60 to 80% okay, not 60, 70 to 85% okay with what is being said here, but you need some time to go over it one more time to make sure you got it, that's normal. But if you think that you're not with me, I'm on another planet and you're in another galaxy, there's something wrong. So this is what I don't want to happen. So I'm not in a rush. If you think you need me to change to go a little bit slower, I'm ready for that. If you want me to repeat, please feel free to engage your microphone and tell me what you need. And this is how we're going to do things in order to promote the learning process.
Can you go back to the slide, please? Yes.
Yes, sure.
The 83 here, it should be 8333s, right?
Yes, I would say yes. I think they have rounded it because 83 by 36, it's 2305. It's not 2314. So this is 83,333. You're right. There are a couple of printing mistakes
No, I
that
guess
we can.
I guess they made the calculations as 83,333 divided by 36.
Exactly, because
Yes.
83 divided by 36, you will not get this number. This is
It's
what
not
I'm saying.
83,
You
it's
will get 2305.
83,330. It's 83,333, that's why.
Yes, yes.
Exactly. So this should be
Yes,
333
yes.
here.
Yes.
Okay, this is what I'm saying. The final answer is correct, but the computation as seen here is wrong. Okay, not a big deal. The number is 83,333. Okay, what they included here is 83 three zeros. So they missed the $333. Okay, but it's a printing mistake. The concept is there. Recognize revenue, step 5. This is a little bit new probably to some of you or to many of you. When or as the entity satisfies a performance obligation. We're going to see here a little bit of complexity. We're going to, link the recognition of revenue as per the contract to the delivery of another product, let's say. So I'm selling you something today, okay? But the recognition of revenue is conditional on me giving you 10 boxes after 1 month, let's say. So sometimes the conditions are a little bit complex in the contract, and this is where the 5-step approach will go into application. But if you're selling simple inventory, someone phoned you, I need 10 tons of whatever cement, you send them the 10 tons of cement, that's it. Okay, so when they receive the cement, you have revenue because we're assuming you have agreed on the price, you send them the goods, they accepted it, that's it. So there is no 5-step approach there in the true sense of the word. But sometimes, yes, we're going to see some complexities, as we've seen a little bit earlier, and what we're going to see here. And this will give rise to the creation sometimes of new accounts, as we're going to see. Contract asset, contract liability. I don't know whether you're familiar with that or not, but we're going to see it. And it's not that big deal. So again, revenue can be recognized over time or at a point in time. We've seen an example there where when you're going to sell the piping, the electrical installation with the apartment, it is at the point in time. So revenue will be recognized when the job has been done. Or sometimes it is over time. Okay, and I'm talking here about something that we're going to see, I think tomorrow, if I'm not mistaken, in F2, that is tomorrow, where we're going to learn how to apply the percentage of completion method and the cost recovery method. Sorry, the percentage of completion method and the completed contract method in a construction type project long term, 2, 3, 4 years. Are we going to wait until we deliver the towers to the government in order to recognize revenue? That's 4 years from now. It doesn't make sense. So we can do it based on some measures of input or output, whichever is more evident. So sometimes it is over time. Sometimes it is over time and conditional to you doing certain things. And sometimes it's simple at a point in time when you deliver the goods. That would be great. So satisfied over time, look at this. This is something interesting, and I'm sure you're familiar with this. Sometimes you do a contract, a service contract. We've done this today. The service contract cannot be recognized as revenue at the time we did the contract. There's no revenue yet. And yes, this has to be done over time because time will give me the room to go to the client and do the service. And before I do the service, I cannot earn the revenue. So like an annual service contract. Sometimes it is like a subscription. So like we're going to go and have a subscription in a magazine or in a gym or in a club. That's the subscription over the year. Okay. So mainly these are where you have to satisfy it over time. And usually it is on a straight line basis. We're going to assume a uniform usage of the service or the usage of the club or the gym. So that's over time. And you can measure, I just said, either using some output methods, okay, or sometimes as input methods. So revenue is recognized based on the value to the customer of the goods and services. So in the case of a service to be performed or a subscription in a gym or in a magazine, I would say it would be logical to go over the straight line method or to allocate it uniformly. Although the client may use the gym in a month more than in another month, but I cannot be that, it doesn't make sense to go into these details. Units of output to be measured, like time, in the example of the gym. So I paid the $1,200 for a year, that's 100 a month. So when 1 month passes, I have the right and the obligation to recognize $100 in revenue. Whereas input methods, usually under GAAP, they prefer the output methods unless it's not practical to have input methods, okay? But usually in the construction type project, the input method is okay. For example, the project is assumed to cost me $10 million. I have already incurred 3 million, that's 30%. So I will do everything based on 30%. I will recognize expenses, revenues, gross profit on the level of 30%. That's the input. So I have decided that how much cost I'm going to incur is my input that I'm going to measure the revenue to be recognized. Straight line basis, we just mentioned that. That's the health club, gym, whatever, 75 per month. I don't count how many times or how many days did this customer visited the gym. or used the gym or the health club. It's 75. It's there. You don't want to use it, that's your choice, but I offered it, it's open, it's there. If I shut down, it's a different story. It's like selling tickets to a concert. So if the artist performs but you were sick, no one will refund you. But if the artist was sick and you came but there were no concert, you will be refunded. So it makes sense. Satisfied over time is a little bit more complex than satisfied at a specific point in time. Okay, we just mentioned that. We will have good examples about it. Okay. Look at this. We're going to see examples that are going to get a little bit more complex every time. We have 2 or 3 examples ahead of us before we finish this module. I would say this is the longest module of the 8. Okay, the remaining modules are shorter and I think less complex. In my opinion, this is very subjective. Look at the example. Again, we have the same example as before. Tanner Co. is building a multi-unit residential complex. The entity enters into a contract with the customer for a specific whatever. Look at this. The contract has the following terms. The customer pays a non-refundable security deposit upon entering the contract. This is important to know that it's non-refundable. 2, the customer agrees to make progress payments during construction. If the customer fails to make the progress payments, the entity has the right to all of the consideration in the contract if it completes the unit. So you paid half, but I finished the contract. I have the right to go to court and ask you to pay me the full amount. I did what I promised to do as per your agreement, but you stopped paying half the way, but I continued. So I have the right to collect everything. The terms of the contract prevent the entity from directing the unit to another customer. This is another important thing that might be perceived as not fair to many, but in the regulation part, you will remember me, the law does not have to be fair. Okay, in many examples, they always say, the international instructors, that the law, it is not necessarily the problem can be solved, which is more logical or which is more fair. The law does not have to be fair. Okay, that's it. Determine whether this performance obligation is satisfied over time or at a point in time. Of course, it's clear that the performance obligation is satisfied over time, but look why. Because the unit does not have an alternative future use to the entity. Look at this. This is interesting. Had the contract says something else here, that I can give it to someone else, the story may or would have been different. The fact that I cannot sell it to someone else, or the contract prevent me from giving it to another one, that's what makes it more clear that it is over time and for that customer. The entity's performance creates an asset that the customer controls because the terms of the contract prevent the entity. Again, they are stressing this point. But I would say this is somehow clear that it's over time we're building. The same example, they changed something in it. The same thing. Okay, the contract has the customer pays a deposit upon entering the contract, is refundable if the entity fails to complete the unit in accordance with the contract. So it is refundable only if I defaulted as a builder from doing my job, not refundable because he or she wants me to refund the deposit. If I fail to continue, it's refundable. The remainder of the purchase price is due on completion of the unit. If the customer defaults on the contract, the entity has the right to retain the deposit. Determine whether it is satisfied over time or at point This is a performance satisfied at a point in time. Look at the difference, because it's not a service contract. The customer does not control the unit as it is created, and the entity does not have an enforceable right to payment for performance completed to date, like in the previous example. That's pretty tricky here a little bit, but I'm sure if you go over the conditions, what makes a contract performed or satisfied over time or at a point in time, and you reread these examples, you will see where are the points that should attract you as to your decision of whether to select point in time or over time. This is what concerns me the most. And this is where we have a couple of examples that are, I assume, new to many of you, and how to present what we've done so far in this part of the chapter in the balance sheet, okay, in the financial statements. And this is where we have this contract asset or contract liability, not an account receivable and an account payable. So there's a slight difference between an account receivable and a contract asset, although both are assets. But when do we use accounts receivable, debit accounts? When do we use contract asset? That's what concerns me. I have two examples ahead of us. We have two examples that will make it clear. However, let's quickly go over the theoretical stuff here. It says contract asset or liability should be presented in the statement of financial position, that's the balance sheet, when either party has performed in a contract. Why? Why do we have to, or when do we have to create this contract asset or liability? It reflects the entity's right to consideration in exchange for goods that the entity has transferred to the customer. It will not make much sense now. Essentially, the entity has performed prior to the customer paying. So why it's not unearned revenue? Actually, the contract liability is the same as unearned revenue. So don't complicate things. The contract asset is different than an account receivable, but I would say a contract liability and unearned revenue is the same or are the same. So it's a contract asset. It's not quite a receivable. This is what concerns me. When do we create a receivable? When do we create a contract asset? We have good examples. If the payment due date is conditioned only by the passage of time, then this would be a receivable. Okay? So if the payment due date is, I expect, so I gave you the goods and services today, I expect to receive the cash from you by July 15th. So it's a passage of time that will decide whether that's the only condition. I cannot call you on July 10 and tell you come pay me. We have an agreement that you will pay me on July 15. This is what we mean by the passage of time being the only condition. So you may ask, what is Samir saying? What other conditions might be there? We will see in an example. It's not only the passage of time. It is me performing, and I just gave an example at the beginning. If I sell you something, but I'm not entitled to collecting the cash until I deliver something else for you, that's not the passage of time condition. That's conditional upon me satisfying something else before I can record revenue. So it's not a receivable yet because I did not perform the other condition. Okay, so I hope you're not confused. So if it's only passage of time in order for me to collect the cash, that's great. That's a receivable. So I have the revenue. I'm waiting for this period of time to pass in order to get the cash. Sometimes it's not that straightforward. Let me show you what I mean. So that's the unearned revenue, and I just told you that unearned revenue and contract liability mean the same thing, so don't get confused with this. A little bit confusion might pop up with the asset receivable versus contract asset. And that's the two examples I'm focusing on when we started. Look at this. This is one example, and the other one will make it even clearer. On Jan 1, Anderson Company enters into a non-cancelable contract with Tanner Co. for the sale of an excavator for $350,000. The excavator will be delivered to Tanner on April 1. Let's stop a little bit here. So far, it is clear that I cannot have any revenue recorded before April 1, the date I will give the excavator, unless there is another condition. But I'm trying to build the problem together with you. The contract requires Tanner to pay the $350 in advance on February 1. So I'm going to give you the excavator on April 1, but on February 1, 2 months earlier, you have to pay me $350. And Tanner makes the payment not on February 1, on March 1. So what do we have here? We have a payment on March 1, and the sale will take place on April 1. I'm going to give you the excavator, the product, the fixed asset, what have you, on April 1. Prepare the journal entries that would be used by Anderson to account for this contract. So obviously we have two entries. We have an entry on March 1 when I received the cash, obviously. And we have another entry when we gave the excavator. Of course, we're ignoring cost of goods sold and inventory. Being an excavator, I assume we're in the business of selling trucks, excavators, earth moving equipment. So we're ignoring the debit and credit to inventory and COGS, cost of goods sold. We're going to cover this in F3. We're going to focus on the receivable or contract asset and unearned revenue, contract liability. Obviously here you have this. Look at this. This is very important. On February 1, remember, what did we do on February 1? We received, on February 1, we were supposed to receive $350,000. Okay? So, since the contract says on February 1, I have the right to receive $350,000, but the customer did not pay me until March 1, I have a receivable under my pillow. So on February 1, I have the right to record a receivable. However, I have also a liability because I need to perform. I did not perform. I did not give the client the excavator. And so actually here, what am I saying? It is as if I am debiting cash, crediting unearned revenue. However, it's not cash, but it's my right. It's non-cancelable. Don't forget, it's non-cancelable. So it's my right. So instead of debiting cash, crediting unearned revenue, I am debiting a receivable, crediting unearned revenue. In this case, I'm calling it contract liability. Now on March 1, what happened? The customer pays me the $350. So debit cash, credit the receivable. On April 1, we gave the customer the excavator. So get rid of the unearned revenue, the contract liability, credit revenue, it is peanuts, provided you like peanuts. So any questions here? So nothing new here. This is, I would say, accounting 1 stuff. Okay, of course, I don't mean to say you don't have the right to ask. Ask no matter how easy it is according to me. It might not be easy to you and vice versa. Sometimes you see things easy, I see it complicated. That's very relative. But I'm saying here, this is an entry that we usually prepare when we receive cash in advance. So we debit cash, credit, unearned revenue. So here, I'm trying to be very clear that the contract is non-cancelable. So I did not receive any cash, but I have the right to receive cash in the future, tied to a condition that I should give them the excavator. This is why I have unearned revenue or contract liability. When I receive the cash, easy stuff. And when I give them what I promised to give them, convert the contract liability unearned revenue to revenue. Of course, there should be some entry to debit cost of goods sold and credit inventory of excavators, but we're ignoring this. Is this clear before we complicate it a little bit and we will be done with this part?
It's clear, but I have one question.
Yes,
Crystal
تفضل
clear,
عبد الجبار.
but at the end, I mean the third entry, if it should be revenue actually credit, but if we put by mistake, or let's say we debit contract revenue liability, sorry, then we debit we credit receivables. It will be wrong, right?
You credit what?
We debit contract liability, then we credit receivables to close.
You already credited receivables in March 1, so you closed the receivable.
Okay.
You're
So
missing
we
this,
can,
I think.
yeah. So we need to close at the third entry the revenue. Okay, that's clear.
To record the revenue, not to close it. To record it, the
I mean
sales.
to
Sales
record,
revenue.
to record, yeah.
Exactly.
Okay,
Okay.
clear.
Great.
Thank you.
Okay. Let's complicate things a little bit. That's two conditions now. On Jan 1, Anderson Company enters into a contract with Turner for the sale of 2 excavators for $350K each. Sorry. But look at the contract terms, and please do not fight the logic. The problem says so, we have to abide what the two parties agreed on. The contract requires 1 excavator to be delivered on February 1 and states that the payment for the delivery of the first excavator is conditional on the delivery of the second excavator. So I will not get paid the first 350 until I deliver the second excavator, which would be delivered in June 1. So on January 1, we had the contract. On February 1, we delivered the first excavator, and we expect to receive the cash for this first excavator when we deliver the second one, which happened on June 1. So at first, it's very important to understand what's happening here. So where do we have entries here? We have an entry here on January 1 for the excavators with the tanners for the sale of 2. No, on January 1, we don't have any entry, I assume. Right? Yes, on January 1, nothing. We had the signature. So we did not provide you with any service. We did not give you any goods. You did not pay us any cash. We did not pay you any cash, nothing. So we signed a contract. There is no accounting transaction. There is a legal binding transaction, yes, but not an accounting transaction. However, on Feb 1, what happened? We gave you the first excavator. Again, ignoring cost of goods sold and inventory. But I gave you the excavator. Okay, so I have here an entry to record what? It is not a receivable. This is the major thing I want to attract your attention to. Why it's not a receivable? Because you are not entitled legally to this amount until you deliver the customer the second excavator. So actually it is a contract asset, but not an accounts receivable. You don't have the right to record it as an account receivable. And yes, I have a revenue as per the revenue recognition principle because I gave you the product, the excavator. However, I cannot, that's the difference I wanted to attract your attention to. That's the difference between a receivable and a contract asset. Both are assets, but look at the technicality. Now, on June 1, what happened? On June 1, we gave you the second excavator, so now we have the right to book a receivable of 700,000. The old 350 that was recorded as a contract asset, I want to convert it to an account receivable. So debit receivable for 350 times 2. Get rid, close the contract asset that was created on Feb 1. It is now a receivable. And yes, I have a revenue of 350 because I delivered you the second excavator. I earn the revenue of the second product. That's it. This is what I wanted really to show you, the difference between an account receivable and a contract asset. That's it. Remember that if you deliver the good to the client, you have revenue, but not necessarily a receivable, because it might be conditional on you performing something else, like in this case. Otherwise, I would have recorded this as an account receivable, and that's it. But since it is conditional that I need to perform something before it's mine, I cannot call it an account receivable. I call it what? A contract asset. That's the only difference between the two. I hope it made sense. Any
Can you repeat it,
questions?
please? Can you repeat it,
What?
please?
Yes, sure. Sundus, look at this. Look at the facts. The facts that on Jan 1 we have an agreement. So nothing we need to record on Jan 1. What does the contract states? What does the contract state? It states that we're selling 2 excavators, each one for 350. One excavator is to be delivered on Feb 1. So I expect to have revenue on Feb 1. But I don't have a receivable on February 1. Why? Because when I deliver the first excavator on Feb 1, it also states that the payment for this first excavator is conditional on the delivery of the second one, which will happen on June 1. So on February 1, I have revenue as per the revenue recognition principle because I gave you the product. Am I entitled for a receivable? Not yet. I cannot tell you, you have to pay me now. It is not also by passage of time. Remember the first example. If the collection of the 350 was mentioned in the contract to be, let's say, collected by February 28, yes, this is an account receivable. I don't have to do any other obligations. I just have to wait until February 28 comes and I will receive the cash. In that case, I would have recorded this as an account receivable. Here, it's not like that. I have revenue, but I even don't have a receivable because this receivable is conditional upon me giving you the second product, which I did on June 1. This is why on June 1, yes, now I have a receivable for 2 excavators. One delivered on June 1, and the other one is the conversion of the contract asset to an account receivable. And the revenue goes to the other excavator. So over these 2 months, I have recorded revenue for 700,000. It makes sense. I have recorded a receivable of 700,000. Forget about the contract asset because I opened it and then closed it upon me satisfying the second condition. Now, of course, at some point in the future, there would be a collection of cash. You will debit cash, credit the account receivable. From here on, it would be a receivable because it's only the passage of time that will dictate when I will get the cash. I hope I answered you, Sundus. If not, please tell me how can I help you.
Yes, it's clear. Yani, contract assets, it's yani temporary account. I will be closing it when I get the full. Okay.
When I satisfy the condition in the contract.
Yes.
Okay.
Yes.
That's the only difference between a receivable and the contract. That's module 1. Let's have a break as usual. And then we will come back and start fresh with a new module that has nothing to do with what we covered earlier. So if you were not really with me during the first module, or it was a little bit tough, give me another chance, join me with module 2. We can start from scratch because it has nothing to do with what we've done before. So let's break for 10 minutes. 10 minutes is enough, I assume. So it's 7:25 Beirut time. 10 minutes, 11 minutes, I'll be back. Enjoy it. It will pass very quickly.
Thank you.
Most welcome.
Mr. Samir, just a quick one. just to
Yes,
to know
sure.
that I understood everything clearly.
Yes, sure,
Uh,
sure.
the difference between them, the contract assets and the receivables, the contract assets will be under condition,
Right.
right? Then the receivable will be without condition, and we are mentioning
Passage
dates.
of time. It's the only
Yes.
condition.
Okay.
Passage of time.
Okay.
You
Okay.
fulfilled your duties as per
Mhm.
the contract, and you're waiting until those 2 weeks, 3 weeks, 1 month to pass. Contract asset, you fulfilled part of your duty, but you're expected to perform something else before you can ask the customer to pay you, and accordingly a receivable to be created.
Which is
You're
the condition,
absolutely right.
right?
Yes, you're right.
Okay. Okay. Thank you, Mr. Samir.
Mr. Samir, I
Yeah,
have one
yeah.
question.
Yes, sure,
Okay.
Abdul.
Riba resume.
Riba.
Okay.
Right.
Okay.
Yes, Riba.
Okay. The first payment is conditional upon providing the second excavator. Okay. So
Yes.
why on June 1, okay, we recorded as a receivable? If we receive the payment, it should be recorded as
We
cash.
did not receive the payment. We did not receive the payment. It says the payment for the delivery of the first is conditional on the delivery of the second. The second excavator, you delivered it on June 1. That they did not say they paid you on June 1. You delivered on June 1. You have now the right to say, show me the cash, Mr. Customer. This is
Okay.
why I'm converting the contract asset to a receivable. It's
So it's
now
due.
I can ask for it.
Okay, it's due, not received.
Exactly.
Okay, thank you.
So let's break 10 minutes from now. Okay. So how was the break? Other than it passed so quickly, the usual thing. So all is okay. I can see probably some new names. No, actually not. Anyone attending for the first time? Did you attend F1 with me? Most of you did, if I'm not mistaken. Okay. Just trying to get familiar with the names. So, Module 2. I promise you this module is, I would say, less complex than Module 1. In Module 1, we talked about the revenue recognition principle, focusing on certain conditions or certain circumstances where some complication might be seen. And in Module 2, we're going to see three things actually, but two of the three will be treated in the same manner. So actually we will be talking about two things, and we're going to focus on the exceptions, because on the exam they love the exceptions. They tell you always in the material, the general rule is like this, but for any general rule there is an exception. So they try to trick you in this exception with this exception in the exam. So don't give them the satisfaction of you being tricked. What are we going to focus on in module 2? Sorry. We're going to focus on changes in accounting estimate, changes in accounting principle, changes in accounting entity, and correction of errors. So we're going to focus on four things. However, many of the four things will be treated accounting-wise in the same manner. This is why it becomes much easier for you to apply the accounting treatment once you remember how are we going to treat those four things accounting-wise. So let's start. What's a change in accounting estimate? A change in accounting estimate is changing, let's say, the lifetime of a fixed asset being depreciated. So it's an estimate. You estimated it's going to live for 10 years. You ended up in the fourth year decreasing the lifetime. You may do this coupled with a change in the residual or salvage value. So this is a change in estimate. You estimated something and then you're changing your mind about it. Remember, how are we going to treat it accounting-wise? Prospectively. So please remember these two terms, prospective treatment and retrospective treatment. Prospective, and this is unique to accounting estimate. All the other three will be treated retrospectively. So actually we're talking about two things, either a prospective approach or a retrospective approach. What do we mean by a prospective approach and when to apply it? A prospective approach will change this year's financial statements and the coming years. Prospective. When are we going to use it or to apply it? With a change in accounting estimate. What's a change in accounting estimate? I gave you a couple of examples. It's not an error. Okay, so it's not an error. The errors is type 4. So we have change in estimate, change in principle, change in entity, correction of an error. The other three will be treated retrospectively. Change in accounting estimate will be treated prospectively, meaning change the year in which you change the estimate, and of course, the future years to come. So that's the prospective approach. Prospective approach is changing this year's financials, and of course, you're looking into the future and the coming years to come. Should the change in estimate be disclosed? Of course, always change in estimates affecting future years must be disclosed in the notes. If it is a regular change in estimate, a slight change, and it is immaterial, you don't do it. So usually we disclose in the notes those changes in estimates that are happening every now and then, not very frequently, like the change, let's say, in uncollectible accounts expense. That's regular. Every year you change the estimate of how much of your receivables will be lost. Whereas a change in the lifetime of a fixed asset and or its residual value, this is less common. The other one, the regular changes, if it is material, you should also disclose it. Okay, so the general rule that any change in estimate that is not ordinary, like changes in the lifetime residual values of assets, this is not ordinary, it should be disclosed. Ordinary, like changing how much of your receivables will be lost, will not be collected. This is ordinary. So usually we do not disclose it unless it is material significant. So these are examples, or sorry, events resulting in estimate changes. Examples include, but not necessarily limited to, changes in the lives of fixed assets, adjustments of year-end accrual of officers' salaries and or bonuses, write down of obsolete inventory. Remember, these do not happen regularly. Settlement of a litigation, economic conditions might give rise to you changing an estimate. The big thing is here, these two things. Change in accounting principle that is inseparable from a change in estimate, and we have two cases. From any inventory flow assumption to LIFO, and the change of the depreciation method, not the life. Let me explain a little bit here. It's a little bit confusing. And this is the exception that I wanted to shed light on when I started talking after the break. We're talking here about changes in accounting estimate. However, there are two changes in accounting principles that should be treated as an accounting estimate change, meaning prospectively. If the company changes from any inventory flow assumption to LIFO, memorize this, not to FIFO or to weighted average or to specific identification, no, that would be a change in accounting principle. But if I'm changing to LIFO, yes, it is a change in principle, but because it's very difficult to apply LIFO retrospectively, we treat it prospectively. So it's an exception to the rule, because a change in accounting method is a change in accounting principle, not a change in estimate. And the depreciation method, any change in depreciation method, yes, someone may say this is a change in principle. You're changing from one acceptable accounting treatment to another acceptable accounting treatment. You're right. But in the case of depreciation, it's an exception to the rule. Yes, it is a change in accounting principle that is not separable from the change in estimate. This is why it is treated as a change in estimate prospectively. Please remember these two. They love to trick you with exceptions. Okay? Is this clear before I move on? Is it clear? Great. Let's take a numerical example. Okay, we will have some examples here, and you know that it's best understood with examples. Let's look at this. And I will try to let you know how to think about, because now we know that it's a change in accounting estimate. But in an exam, when you're finished your studies, while you're studying, how can you tell? Remember, a change in estimate is changing the lifetime of an asset or an estimate. A change in principle means you're changing from one acceptable method to another acceptable method, with the exception of 2 LIFO and the depreciation method. Okay. Carl & Co. buys a truck for 90. The truck is expected to last for 10 years. During the third year, please be very cautious here. So after depreciating it for 2 years, during year 3, Carlin realizes that the truck is only going to last a total of 5 years. So they decreased its lifetime from 10 to 5. First, I'm changing the lifetime of a fixed asset. There's no space here or room for making a silly mistake. It's a change in estimate. And how do we treat it? This year and the years to come. The truck is depreciated on the straight line basis and has no estimated salvage value. Create a depreciation schedule for the life of the truck over 5 years. Easy stuff. What's your depreciation expense in years 1 and 2? 90,000 divided by 10 years, that's 9,000 a year. So in year 1, I should assume that the company has recorded a 9,000 depreciation, another 9,000 in year 2. So what's the net book value in year 3 when I did the change? That's very important. So 90,000 minus 18, 90 minus 18, that's 72,000. That's the net book value at the end of year 2 or during year 3 before recording depreciation in year 3. Now it says that the asset will live only a total, look at how cautious you should be, a total of 5 years. They could have said another 5 years, then 7 years would be the total lifetime. So a change in one word will do magic. They are changing the lifetime from a total of 10 to a total of 5 when, after using it for 2 years, having an accumulated depreciation of 18,000, net book value of 72. Now it's going to live for a total of 5. We already used it for 2. We're going to divide the 72 by 3. So it's 24 a year in years 3, 4, and 5. And the schedule is here for you. And I have already done it verbally. Let me walk you through the computations. In years 1 and 2, depreciation straight line cost by life. So 9,000, that's the net carrying value. I called it net book value. Please know both, they are commonly used. The net carrying value, meaning by how much the asset is carried on my books, or the net book value, the how much is the asset recorded in my books. Now this is the change. The 72 by 3, why by 3? Because the overall lifetime is now 5. You used it for 2, the remaining is 3. So it's very useful to find the net book value, especially in the year in which the change has been applied. Of course, where's the prospective approach here? We're not going back and changing depreciation for years 1 and 2. So we're changing depreciation expense in the year in which we changed, and in the coming years. That's the prospective approach. Give me an okay so that I can continue. Great. Is this change in estimate going to affect quality earnings? Yes, of course. Why? Because depreciation used to be 9,000 in year one. It's 24 in year two. So everything else is the same. Assuming everything else the same, you have a 15,000 decrease in net income because of this change in accounting estimate. Okay. And what do we agree on that? We should put this in the notes. So remember this here. Where is, should the change in estimate be disclosed? Change in estimate affecting future years must be disclosed in the notes. This is not an ordinary change in accounting estimate. I'm not changing whether I'm going to lose this much of receivables or that much. This is something that I follow every month or every quarter or semi-annually or maximum once in a year, minimum once in a period. Whereas changing the accounting lifetime of fixed assets, yes, this is not very common. And yes, it should be disclosed in the notes. And I'm showing you why it should be disclosed, because there is a 15,000 drop in net income if exactly this year was identical to year two. There is a drop of 15,000, not because I was inefficient as management, because I changed the lifetime of a fixed asset. Changes in accounting principles or entity. Why are they merging these? Because the accounting treatment is the same. And what do you think the accounting treatment here should be? Not prospectively, it's more complex. It's retrospectively. And what do we mean by that? You have to restate all your past financial statements that are presented in your annual report for comparative purposes, and the beginning opening retained earnings for the earliest year presented, covering all the years that are not presented. Let me give you an example, quick example, and we will see numerical examples. What is a change in accounting principle? I'm changing from weighted average to FIFO. I'm changing from an acceptable accounting method to another acceptable method. And this will have an impact on my cost of goods sold and ending inventory. My retained earnings will change because net income has changed. Okay, and I'm presenting, I used to use, let's say, weighted average, I'm changing to FIFO. And I'm presenting financial statements in comparative terms for this year and last year. I changed this year. So I should apply now FIFO this year, and I should restate last year's financial statements as if FIFO was used back then. Okay, so that's the retrospective approach. I'm not changing this year and the future. I'm changing this year and of course the future, but I'm also restating the financial statements that are presented for comparative purposes. I'm changing them to reflect the numbers as if this new method has been applied ever since. What about the years that are not presented? So I'm showing 2025, 2024. I changed them. What about from 2020 to 2024 if the company was created in 2020? The cumulative effect of these 4 years will be reflected in the opening retained earnings of 2024. Okay? Of course, in the exam, Abdul Jabbar, you said something or you were adding to what I'm saying?
Yeah, I said it will remain the same, right? Only we will affect the prior year, isn't it?
Retained earnings, the opening retained earnings of 2024 to reflect the changes or that change in 2022, 2021, and 2020.
Only
Cumulative
earnings. Okay.
Exactly. So the retained earnings of 2024 will be affected the beginning retained earnings, reflecting all the change, the effect of the change on the past years that are not presented. We will see numerical examples again. And of course, in the following few slides, you're going to read what I just explained somehow. So changes in accounting principle, general rule, retrospective approach. What's an exception to this? Changes to LIFO and changes of depreciation methods. Because again, the change in depreciation method might be very attractive to you to think it's a change in principle because I'm changing from one accounting acceptable method to another, right? But this is the exception. So to LIFO and depreciation methods, yes, actually they are changes in accounting principle, but this is inseparable from a change in estimate since depreciation as a concept is based on estimation. So we treat it prospectively as an estimate. Everything else, yes, is retrospective, meaning what's on this slide and what I just explained. Of course, the adjustment must be done to the beginning retained earnings multiplied by 1 minus the tax rate to take care of the effect of the change on net income and the taxes that now need to be adjusted, and this should be reflected in retained earnings. So that's exactly what I was saying. Look at this, it's interesting. Going from cash accounting to accrual accounting is a change, is a correction of an error. Why? Because I'm not moving from an acceptable method in accounting to acceptable. For reporting purposes, cash basis accounting is not acceptable. So if the company was using cash basis accounting, this is an error. And an error should be corrected prospectively. Retrospectively, in the same manner as change in accounting principle, but it's not a change in accounting principle. It's a correction of an error. So this might pop up in an MCQ. Which of the following is a change in accounting principle? Blah, blah, blah. Remember, change in accounting principle should be from an acceptable accounting method to another acceptable accounting method, with the exception of these two LIFO and depreciation methods. I think you should, by now, should have got it. If not, please ask. Of course, you cannot change every day or every week. The auditor will not be happy with that, and he or she will not accept the change. So the change should not be done because you want to show a positive net income or a lower net income to pay less taxes. This is fraudulently reporting. Of course, auditing wise, this is not acceptable. Okay, so the auditor should be convinced as to why you're changing, and the change should be because this is for the betterment of everyone. So it is now reflecting fair value of the assets or more accurate for fair value, although I'm applying the cost principle. This would have a greater positive impact, fair impact, not positive, fair impact on net income. This is the actual net income. These are simple examples as to reasons why a company may select to change an accounting principle. This is why the treatment should be very strict and it should be very well followed, because this is something that will not happen every year or every few years. It may happen once in a lifetime of a company or once in many years. So income smoothing is not allowed. So let's change from this method to this method in an increasing price environment. FIFO will give me a higher net income because I'm always selling the older units, the less expensive units. COGS will be lower, gross profit will be higher. So if you were using another method, but you're flipping now to FIFO because you want COGS to be lower, gross profit to be higher, stop right there. This is income smoothing. This is fraudulent reporting. You're manipulating the numbers. It should be justified. Okay, so I just talked about that. The cumulative effect, this is where we want to change the beginning retained earnings for the earliest year presented. This would be the cumulative effect of this change. Had this change been had been applied since the start of the company. Okay, and whenever this is not practical to be done, but now with the use of a computer, anything can be done. If it is not practical to be done, you can use the prospective approach. This is why LIFO is okay to change to LIFO. It's very difficult to do the retrospective approach. This is why changing inventory flow assumptions from anything to LIFO is an exception to the rule. Yes, it is a change in accounting principle. It should be treated retrospectively, but stop right there. This is an exception, so you treat it prospectively. I think all what was said by me multiple times is now being documented on the slides. Use the new method in the year presented, let's say 2024. Calculate what earnings would have been if the new method had always been used. Adjust beginning retained earnings for the years that are not presented, 23 and before. Remember to show the effect net of tax, meaning the adjustment times 1 minus the tax rate. If comparative financial statements are presented, you should restate all the statements that are shown as if this method has been used throughout these years, and for the earlier one presented, change only the beginning retained earnings to reflect the cumulative effect of the change on the years that are not presented, as we've done earlier, or what, as I said earlier. So new method should be used in all years presented. Calculate the cumulative effect, present cumulative effect net of tax as an adjustment to the beginning retained earnings in the statement of stockholders' equity or statement of changes in equity. Don't forget that the adjustment or the cumulative effect should be presented net of tax. Let's take a numerical example, couple of numerical examples, and we can go directly to the adjusting entries. Are you okay with that? Am I going too fast, or is it okay? Great, great. Abdul-Jabbar is giving me the okay to continue. I assume all the rest are happy with what's happening here, or they are completely disconnected with what's happening here. I assume the first one.
We are
Okay.
here.
Great. Thank you, Sandos. Thank you. I'm sure you're here, and I'm sure, although tired, but I'm sure you can cope with it. I have full confidence in you. Facts. Let's read the facts and let's decide on what are we dealing with here, and then we will decide how to deal with what we're dealing with here. On Jan 1, Year 5, Harbor Co. decided to switch to the weighted average method of inventory accounting. So there is no exception. I'm changing from whatever, I don't know, to weighted average. So it's a change in accounting principle. And how do we treat this? Retrospectively. Prior to year 5, Harbor used FIFO to account for its inventory. Harbor's effective tax rate is 30. So we're moving from FIFO to weighted average. So a pure change in accounting principle. Pre-tax income prior to year 5 was 600 using the old method. Pre-tax income prior to year 5 would have been 800 using the new method. So they are giving me all the numbers on a plate of silver. It's your now duty to know how to use these. The cumulative effect of the adjustment is 200,000 pre-tax. Okay, so the cumulative effect is 200. Calculate the cumulative effect net of income tax of the change in accounting principle. Non-comparative financial statements only show year 5. So we have 600,000 using the old method. Had we used the new method back then, net income would have increased to 800. That's the cumulative effect, 200. But we need to show it less net of tax. So 200 multiplied by 0.7, that's 140. So retained earnings should be adjusted as an increase of 140. Okay. Why retained earnings? Because they are telling me there are no comparative financial statements presented, so non-comparative. So we are only working with year 5. So year 5, of course, I'm going to apply now the weighted average in year 5. So COGS ending inventory in year 5 are now presented at their new or at the numbers reflecting weighted average. But retained earnings, beginning retained earnings should reflect the changes for the previous years had weighted average been applied since the start of the company. So again, that's the cumulative effect less the tax. That's the 140 net of tax. So the 140 cumulative effect should, again, they are telling us, would adjust the beginning retained earnings wherever beginning retained earnings is. And where is beginning retained earnings? In the statement of changes in equity or the statement of retained earnings. So again, repetition. Where or how to report changes in accounting principle? Retrospective approach. How do we do this? For comparative financials, adjust beginning retained earnings for the earliest year presented and restate all the years presented to reflect as if the new method has been applied back then. Only 2 exceptions is 2 LIFO and depreciation methods. That's it. So if it's impractical to estimate, you can use the prospective approach. This is why 2 LIFO is an exception. And change in depreciation method for the reasons I mentioned earlier, and I think I mentioned them multiple times. Please, when I say I mentioned them multiple times, I don't mean to tell you you don't have the right to ask. I am ready to answer your questions, whether I repeated the answer 10 times or 100 times. If it's not yet clear, I will either change the way I'm explaining, or I can tell you I'm out of new methods. I will contact you after or contact me after the session, or after you try working with it, studying it. If you still have problems, please let me know. Again, repetition in different ways, either in a paragraph format or in a table format, but that's it. I'm repeating it over and over, and it is being repeated here over and over. For a very good reason, okay? You know that the exceptions are heavily tested. Changes in accounting entity. We're not going to see an example here, but it's the same treatment as a change in accounting principle. What's a change in accounting entity? Let me give you an example so that you get it. But first, let's agree, a change in accounting entity will be treated retrospectively, meaning what we did under the change in accounting principle will be applied here. So we change all the years presented, and we change the beginning retained earnings for the earliest year present. Like, what do we mean by change in entity? This year, a company purchased another company. So at year end, they have to consolidate the financial statements. So I now own more than 50% of the capital stock of another company. So I have the obligation to do a consolidated set of financial statements. So in 2025, if I'm going to show my income statement consolidated with the other company, and I'm comparing it to 2024, where I was not consolidating because I was not owning any shares of stock in that company, will I be comparing apples to apples? No. So the same concept as the change in accounting principle. So I need to restate 2024 as if I was owning that company, or 50% or more of that company, and I should consolidate the financial statements assuming 2024 is presented. And again, you have to change the beginning retained earnings for the earliest year present. So changes in accounting entity may be the result of a merger or an acquisition or a divestiture. the opposite of merger. I sold the part of the business. So I'm no longer consolidating A and B. I'm A again alone. So again, the accounting treatment, remember, it should be restated for all the financial statements presented. That's the retrospective approach. And restate again the beginning retained earnings if it has changed. So this is just an example. That's the comparing apples to apples. So ABCD, company D is a new acquisition. So last year I was ABC. Now I'm ABCD. If I'm going to show this year ABCD compared to last year ABC, I'm not comparing apples to apples. So I need to restate last year's financial statements to show the consolidated financial statements ABCD. Although last year it was not there, but for comparative purposes, I need to assume as if this consolidation has happened last year. Full disclosures, of course, you know that this all has to be disclosed in the notes to financial statement. So we're done with the change in accounting estimate, prospective, change in accounting principle, general rule retrospective with couple of exceptions, change in accounting entity, and error correction. Error correction, as the name indicates, it's a prior period adjustment. That means retrospective. So I have to, if I discovered that 3 years ago I made a mistake, I need to correct that year. So I need, and I'm presenting it, I need to correct that year. And if the effect has, or the error has an impact on other accounts, I need also to change these accounts retrospective. Error corrections are not accounting changes. Why? Because I'm not changing from an acceptable accounting method to another acceptable accounting method. I violated GAAP. So I forgot, let's say, to depreciate a fixed asset, or I depreciated it in a wrong way, or I did not, an arithmetic mistake in computing depreciation. I forgot to deduct, let's say, the residual value in my computation. All of these are error correction. Okay, why? Because it's an error. So I made an error that year, correct. Error corrections, okay, that's an example of what I just said. Mathematical mistakes, application, wrong application of US GAAP, whatever. And remember, changes from cash to accrual. Yes, it is an error because I'm not changing from GAAP to GAAP. I'm changing from non-GAAP to GAAP so that it fits perfectly here. Again, look at the scenario being repeated again and again. If the year is presented, if comparative financial statements are presented and financial statements for the year with the error are presented, merely correct the error in those prior financial statements. Adjust beginning retained earnings of the earliest year presented if the year is not presented. So the same exact treatment of change in accounting principle and change in accounting entity. Okay. If comparative financials are not presented, the error correction should be reported as an adjustment to the opening balance of retained earnings. If the year in which the error has happened is not presented, it happened before, then adjust the beginning retained. The same thing. So I'm not changing a word that was said earlier in other examples. Let's see a numerical example. You should be okay, I assume, after you see it in application. Here we have two things that happen. So don't get overwhelmed with the given. It appears to be big, but it is two problems in one. Calculate the required adjustments for the depreciation error and indicate how this correction should be presented in the financials. So let's deal with it first, and then we will come back to this part of the given that is to be used in number 2. Facts: in year 4, Jordan Manufacturing discovered that depreciation expense was incorrectly calculated in years 1 and 2. Actually, there is a printing mistake here in 1, 2, and 3. Okay, so because I have prepared it, so I know there is a mistake. So, and they, at a later slide, they will mention that it is years 1 to 3 or 1 through 3. So obviously here it should be 1, 2, and 3. In total, this is what concerns me. 4.5 million of depreciation expense was not recorded during these 2 years. Then the rest goes to what? To number 2, because it talks about changing inventory flow assumption. So that we don't mix things together, let's deal with this. How are we going to present this? So in year 4, we discovered that in years 1, 2, and 3, we missed depreciation, in total 4.5 million. So how are we going to do? It depends, are we presenting those years or not? So presentation of the depreciation error correction in the financial statements. So as Jordan is presenting financial info for only year 4, then correct the error, the depreciation error should be reported as an adjustment to retained earnings net of tax. Why is that? Because in year 4, I discovered the problem, so I should have corrected it in year 4. But years 1, 2, and 3 are still presented in a wrong way. But since they are not presented, I don't have to restate them, but I need to take the cumulative effect, the 4.5 million, and adjust this year's, the presented year, the change in the beginning retained earnings. So what's the effect? It's 2.7. From where did we get it? It's the cumulative effect of the change multiplied by 1 minus the tax. Okay, as easy as this. The other one, if you don't have questions, sure. The other one deals with inventory flow assumptions. Let's read. At the beginning of year 4, Jordan Manufacturing decided to change inventory methods from LIFO to FIFO. So this is not an exception, okay? We're changing from LIFO to FIFO, and this is not a change in this is a change in principle. This is not an error. So they are mixing two things in one problem to distract you. Don't be distracted. The first one we dealt with as a change in what? An error. The other one is an effect, a change in accounting principle, because I'm changing from GAAP to GAAP, but not to LIFO. From LIFO to FIFO. The following info details the pre-tax income under each one. So year 1, LIFO was used. If FIFO was used, then net income would have increased by 750, year 2 by 2.1, year 3 by 2.15 million. Tax rate is 40%. Great. Ladies and gents, if years 1, 2, and 3 are presented, then we have to restate the numbers in the years in which the change happened, and to restate the older years to reflect as if FIFO was used back then. And if 1 year is only presented, then the cumulative effect, which is 5 million, that's it, 250, yes, 5 million times 1 minus the tax rate would be reflected in the opening balance of retained earnings of year 4. So nothing that was not said. That's the 5 million net, net of tax, 3 million. The cumulative effect for the change, okay. And that's it. To retained earnings should be reported as an adjustment to retained earnings or net of tax. That's the retrospective approach. Had years 1, 2, 3, and 4 been presented, then I should have changed. That's the retrospective. I should have changed year 1, 2, and 3 to reflect as if LIFO, FIFO was used back then. Remember, again, they are reminding us of the exception. LIFO to FIFO, change in principle. anything to LIFO, change in estimate, and this is a great reminder for you here. This is an exception. They love exception. Yes, Ibrahim.
Doctor, just question. If we go,
Yes, sure.
you go back to the previous slide, the 750,000, can't we just reflect the difference in the 750 in year one? I mean, net of tax, of course, or no?
Yes, I agree. I agree. It depends whether you are presenting year 1, 2, and 3 in comparative form or you're just presenting year 4. Here they are assuming that we are not presenting years 1, 2, and 3. So we are presenting only year 4. So the impact would be reflected in the opening balance of year 4. But if year 1 was presented, the 750 net of tax should be there. In year 2, the 2.1, and in year 3, the 2.15. Yes, you're absolutely right.
In the exam, do we assume that, like, will they explicitly mention that we need to disclose the net amount for year 4 or no? Or يعني by default, do we consider?
It should be clear. You're absolutely right. It should be clear. I think it is clear here. Let me reread this to make sure. At the beginning of year 4, the following info. Let's see the question down there. What does it say? Calculate the required adjustment for the depreciation and how should be in the financial. No, it's not clear. You're right. So here the assumption is that year 4 is only presented. There is no comparative financial statements. I would say in the exam, it can't be like this. It would be unless it is a task-based simulation and you have to fill in some missed numbers so you can tell whether it is comparative or not. But in an MCQ, it should be very clear whether it is for comparative purposes, if they are presented or not. Yes, you have a point in what you're saying.
All right, thank you.
Yeah, hello, Ibrahim. So again, this is a summary of questions 1 and 2. Okay, that's the 2.7, you remember, that's the 5 million, that's 2. Nothing that was not said, but again, the solution is presented on one slide rather than number 1 on one slide and number 2 on another slide. So that's the end of module 2. 6 more to cover. Don't faint. I'm not saying today 6 modules. I would say if we can cover adjusting entries today, that would be great. Any questions, ladies, gents? Any questions? All is okay.
It's good.
Great, great. Again, if you just joined me or you had been distracted for any reason, you can still rejoin now because this is something that has no relation to anything that was covered earlier. And what's this? Adjusting entries. And I told you at the beginning of the session today that for an accounting 1 student, this is a pain in every part of his or her body. You know that the adjusting entries are challenging. And actually, not only for accounting 1. I would say I worked for the private sector as a chief accountant for 13 years. Always it is challenging, or they have some I mean, you have to think about them. It's not just copying, pasting, or whatever. You have to remember what accounts need to be adjusted and why do we adjust them and how to adjust them, and not to miss any account that needs to be adjusted or to adjust any account that does not need adjustments. Accruals, deferrals, you really have to be very strong, very solid in this, and I'm sure you are. But it's part of the CPA exam. Let's go over it. Why do we need adjusting entries? Simply, we need adjusting entries to end up really making sure that the revenues that should have been recorded are actually recorded, and all the revenues that should be deferred or postponed are deferred. And by the same logic, I want to make sure that all the expenses that have been incurred not necessarily paid, should be recorded, and all the expenses that should not be recorded as an expense are not recorded as an expense. So simply, I want to make sure that the matching principle is being applied over this accounting period. So I want to make sure that all the revenues and expenses are recorded in the proper accounting period. That's the objective of the adjusting entries. This is why we have accruals and deferrals. Let me remind you of the terms. I'm sure you know what we're talking about here. What are deferrals? Deferrals, of course, when I say deferrals or accruals, I'm talking about deferred revenue, deferred expense, accrued revenue, accrued expense. So what's a deferred expense? A deferred expense is anything that you pay for it now, but you capitalize it. I mean, you record it as an asset. And of course, as time passes or as it is used up, you convert it to an expense. That's a deferred asset. So paying rent in advance gives rise to a prepaid rent asset account. Paying insurance in advance, paying for any fixed asset is a deferred expense. Yes, when we purchase inventory, when we purchase supplies that are going to last for several periods, all of the above are deferred expenses, meaning we record them as an asset, and then through these adjusting entries, we convert part of them to an expense according to our estimation or to how much actually was used of them. That's a deferred asset. What's a deferred expense? What's a deferred revenue? A deferred revenue is unearned revenue, contract liability. It is when a customer pays you in advance, but you did not perform yet. So you're deferring the recording of revenue. You're postponing. We record it as a liability. That's a deferred revenue. So these are the deferrals. What are accruals? The other side of the coin. What's an accrued revenue? An accrued revenue is when you perform what you promised to perform, but the collection will be later on. So that's an accrued revenue, a revenue that has been earned but not yet collected. By the same logic, what's an accrued expense? An accrued expense is an expense that has been incurred. Someone provided you with a service. So the expense has been incurred, but you're going to pay later on. As with the agreement with the guy, we're not trying to not pay him or her, definitely not. So that's accrued means if it's a revenue, it's earned but not collected. If it's an expense, it is incurred but not yet paid. Yes, I saw a hand and then
Yes, that would, yes, that would be
yes,
the
sure.
I know I'm going out of the subject, but in IFRS for contract, there's nothing called like they are removing deferred revenue and deferred expenses. So, but in particular for this exam, unearned revenue, can we link it to contract assets and contract liabilities?
Contract liability is unearned revenue, but contract asset is not an account receivable. But yes, they are linked somehow to what we're talking about here. Okay?
Yes, okay.
Okay, Bob? What's the purpose of journal adjusting entries? Is to record revenues and expenses in the correct period. That makes a good multiple choice question, by the way. Okay, so not necessarily when cash has been transacted, yes or no. We have a great comprehensive example. My plan is to cover it all today. Okay, and I want your input. Okay, so I want your input later on. So what's this? This is a deferred revenue. Someone pays you in advance. That's the entry, you know it. What's this? That's the adjusting entry. When you provide what you promised to provide, you convert the unearned revenue or part of it, depending on the part you have fulfilled, into earned revenue or revenue. So I'm going a little bit fast here because I assume this is easy to you. If not, please stop me. And remember, look down there. Again, this makes a good MCQ. An adjusting entry, a regular adjusting entry, can never include cash. That would be a correcting entry if a mistake was done and you're reversing something. But a regular adjusting entry, deferrals, accruals, recording, it cannot include cash. Why? Because if cash has been transacted, this gives rise to a transaction, which in turn should be recorded through a journal entry, not an adjusting entry. And actually, this is, and I'm sure you know this, this is what makes adjusting entries challenging. There is no supporting document across the board. Okay, so I know that an invoice was received by me. This will trigger me to record a journal entry. There is a transaction, an invoice, a supporting document that will tell me, Samir, wake up, you need to record this. Adjusting entries, there are no supporting documents in the real sense of the word. You should know that you should record depreciation, you should record part of the unearned revenue if earned, you should convert part of your prepaid rent unexpired insurance, you should convert inventory to cost of goods sold. No one should tell you or will tell you, hey, do it, or there is an invoice, or there is a supporting document telling you to do it. That's what makes it challenging. What's this? This is a deferred expense. I'm paying for something in advance. Rent, insurance, I'm purchasing a fixed asset. I debit a prepaid expense, which is an asset, and the asset can be prepaid rent, unexpired insurance, or the fixed asset itself. I am paying for it now, so credit cash. However, I need to convert part of this asset to expense as it is used up. Why? Matching principle, because this asset has been used, supposedly, otherwise why did you purchase it? Supposedly it generated some revenue to the company, and this revenue supposedly was recorded as per the revenue recognition principle. Great. Part of this asset that supposedly generated revenue should be recorded as an asset, as an expense, sorry, to end up matching revenues and expenses in this period. Accrued revenues and expenses. So what's these two? These are the deferred revenues, deferred expenses. Now we're going to see accrued revenues, accrued expenses. That's an adjusting entry. It can be a journal entry, but sometimes at year end or at month end, the company will do some sort of a clearance to make sure that all the services that were provided to customers were billed. If not, you need an adjusting entry to bill the customer by debiting a receivable, crediting the revenue because you earn it. And yes, it might not be a year-end adjusting entry. It can be a journal entry, this one. But I mean, sometimes the adjusting entry would be to record a service that was provided, but not recorded in your books. The expenses is the other side of the coin if I'm talking about accruals, accrued expense. Accrued expense, someone provided me with a service. So they sent me the gas bill for the company's, vehicles, $2,000. I have 15 days to pay. Accrual accounting. I used those vans. The vans generated revenue for me. And this revenue supposedly was recorded. I need to record the gas that was spent during this month, this period, whatever. By debiting the expense, crediting an accrued liability, a liability, accounts payable, call it what you want, it is a liability to you. They love the analysis. This is why on the right here, I'm skipping them because I assume you know how to do that, of course. So they love the impact of the entry on total assets, total liabilities, total net income. And I'm sure you know how to do it. If it's an expense, it will increase the expenses, decrease net income. Decrease net income means retained earnings has decreased. And on the left side, either we have an increase on the liability to compensate for the drop in equity, or you paid for it in cash in a case of a journal entry assets drop. Error corrections, that's not an adjusting entry. Okay, so I did an entry and I need to reverse it because it was by mistake done or for a wrong number or whatever. So you reverse it or you do a correcting entry. This is outside the 4 types I talked about earlier. Adjusting entries. Is this the comprehensive example? No, I don't think so. So we have a couple of examples here, and then we will go to a comprehensive example. I hope I will be able to finish it this evening. Look at this example. On December 1, year 1, Impact Incorporated received $250 in cash for services to be performed equally during December year 1 and Jan year 2. What's the entry to record the receipt of the $250? Debit on December 1. Debit cash, credit unearned revenue. By the end of December, I assume that half the work has been done because this is what they are telling me. So I have the obligation to convert half the $250 from a liability unearned to earned. So that's the 2 entries here. The journal entry on December 1, the adjusting entry on December 31. Do you have any questions here, ladies and gentlemen?
In a task-based simulation, can we call this contract liability, credit contract liability, debit cash credit contract liability?
Yes. Yes, I don't mind. The unearned revenue and contract liability are synonyms. This is what they said in the contract liability. But I would say the use of unearned service revenue is more common, I would say. Whereas accounts receivable and contract asset, no, it's a different story. They cannot be used as synonyms. Please pay attention to this. Okay, Bob? Rahim?
Yes, thank you.
Yeah, hello. Anytime. Look at the facts here. On November 1, year 1, it should be an accrued expense here. Impact borrowed $2 million from Federal Bank at a rate of 3% with interest due annually on November 1. The principal will be paid back on November 1, year 2. So when they say it is 3%, it's 3% annually, always. Okay. So 2 million, that's the principal, multiplied by 3%, that's 60,000 per year because 3% is yearly. So how many months have passed? They want us prepare the journal entry, so debit, cash, credit note, easy, and the adjusting entry for the accrued interest at year end. Okay. So how many months have passed since we took the loan? November 1 till the end of December. November, December. So if 60,000 is the interest per year, divide 60 by 12, you will get it per month, multiply by 2 to get it for 2 months. That's the 10,000. What's the journal entry, the adjusting entry? Accrued expense. What do we mean by accrued expense? It's an expense that has been incurred, so go and book it by debiting interest expense to be paid later on. This will give rise to an interest payable liability account. I'm sure this is basic for you. I hope I'm not too fast, but please, again, if you have questions, ask. But I assume for the CPA, this is easier than other things. This is basic. This is not new to you, I assume, right? Yes, Ibrahim.
Can you please go back to the previous slide?
This one?
Yes. At year end, if at the task-based simulation, will they ask us to record the remaining balance? But when I say
why not? They can.
Yeah.
Why not? They can ask you anything. In the comprehensive example, we will see in the comprehensive example I'm targeting for this evening, they tell you the company did this wrong prepare the entry to correct the mistake. So it's not a straightforward application to do the adjusting entry. It's the entry that will correct the balances perfectly well. So probably this will answer your question better. Okay. Comprehensive example. How many minutes do we have? Around 15, 20 minutes. We will be done hopefully this evening as my plan was set. Of course, this is, insulting to our intelligence to tell us that expenses are recorded as debits to increase and credit to decrease. But yes, this is just what a refreshing, I would say, passkey, but it's ABC of accounting. Look at this example. Titan Company reported pre-tax income in year 2 of 8,000. Upon review of the general ledger, the following info listed in the first column was discovered. If necessary, record an adjustment to pre-tax income in the table. So let's prepare the adjusting entries to fix their mistakes. So let me show you what I mean in this example. Unfortunately, the answer is down there, but I'm sure we can explain what's happening here. Look at this. This is given, and we don't care about it actually. We care about this. Look at this. The company purchased a $300 3-year insurance policy at the beginning of year 2 and expense it all on the payment date. So what did they do? They debited insurance expense, credited cash. Of course, we know for a fact that this is not a proper entry. Why? Because we should have allocated the 300,000 over 3 years, 1 per year, 100 per year. So how are we going to fix this? And this is a little bit challenging because we can do a silly mistake. What's the entry that will fix this? Of course, you have the option, but not in the exam probably, first to reverse this and then to prepare the correct one. But here, this is not an option. We want to jump from this wrong entry to the correct entry. Help me with that.
We have to amortize again, prepaid insurance to insurance expense.
How much, Hamad?
200.
Excellent. Very good. Yes, look at this. They recorded insurance expense for 300. By how much I want it to be? By 100. So I need to credit insurance expense by 200. This is what Muhammad said. What's the debit to create the prepaid insurance account, unexpired insurance for 200? So the entry to correct this would be exactly what Muhammad mentioned. We debit the prepaid insurance, we're creating an asset for 200, and we're decreasing the insurance expense that was recorded for 300, we want it only for 100. So this is a little bit tricky. It is trickier than saying prepare the journal entry and the adjusting entry then correctly as we did earlier. So we have 6, 7 examples, probably 8, that they tell us what they did, and it's a wrong treatment. They want us to prepare the correcting, adjusting entry to bring things into the correct amounts for all the accounts affected. Let's do number 2. $2,000 of credit sales made during year 2, credit sales, were not recorded in the ledger because they had not been collected in cash. What a silly mistake. And how do you correct this? Do we need to prepare any entry here? The answer may be everything is okay, don't do anything. Not here.
Account
Muhammad
receivable
again.
to revenue.
Sorry, Muhammad, I did not get it.
account receivable to revenue?
Of course. Very good, Muhammad. Yes, this is the entry that should have been prepared originally. They did not prepare anything because it's a credit sale. It was not received in cash, so they did not do anything. But we know that accrual accounting says a different story. Yes, the entry should have been debit accounts receivable, credit sales revenue. Are we okay with that? Am I going too fast or it's okay? Try this. Number 3. Cash totaling 3,000 that was received in advance from customers was recorded to service revenue. Of course, this is a big mistake. Only 30% of the services had been performed by year end. This is the wrong entry. What's an entry that would correct things?
The unearned revenue
How much?
for
Credit, debit, and for how
2,100.
much?
Debit,
Yes, Abdel Fattah.
debit cash for 3,000.
It is debited.
Yes,
Cash
credit.
has been debited.
Yes, the credit unearned revenue for 2001. Or credit service revenue for 900.
Rethink. Part of what you said is correct, Abdel Fattah, but the other part is wrong. Is not correct. Cash is correct. Yes, we received cash.
Should we debit it?
You want to debit unearned revenue, Sundus?
Yes, because it's
Debit unearned revenue? Unearned revenue is a credit natured account. It does not exist. You're debiting it, you're taking it below zero. Rethink.
It should be like cash revenue is like 900 and unearned revenue is 2,100.
Can you repeat, Muhammad?
Cash is 3,000 is debit and revenue
It is debited.
Yeah, revenue is 900 and unearned revenue is 2,100.
No,
that's the original entry if you want to
Yes.
to do it correctly. But I want to move from here to the correction.
Debit
You cannot
revenue.
debit cash again.
Yes, debit revenue for 2001 and the credit unearned revenue 2001.
Why and one?
Because 30% is collected.
2,100 you mean? Yes,
Yes,
you're absolutely right.
2,100.
You're absolutely right. You're absolutely right. They recorded 3,000 in revenues. That's the big mistake.
Yes.
Revenue is how much? It is 2,100 because at year end 30% has been earned. So 3,000 by 30%, that's not 900. 900 has been earned. So I want to decrease revenue by 2,100. So this is why we should debit revenue by 2,100 and credit unearned revenue by 2,100. That's the entry that should have been or should be made at year end to correct things.
so this
The cash
entry
has
is right for the 900.
Sorry?
This entry is right for the 900. صح؟
What do you mean right for the 900?
يعني we decrease the revenue because it's
Exactly.
not really
Exactly. Now your sales revenue is 900. On a T account, it was credit 3,000. I debited for 2,100. Now revenue earned is 900. And this is the correct amount. This is what I earned, although I received 3,000. Okay, Sundus? Okay,
Yes.
everyone?
Yes.
That's not easy. I'm sure you know everything about this, but you're confused about doing the entry right from the beginning or taking things from the mistake to the corrected amounts. That's a little bit challenging. Pay attention to it.
But can I ask one question?
Yes, sure, Muhammad.
Why debit, let's say debit cash 3,000 and credit deferred revenue 2,100 and credit service revenue 900? Why it's wrong?
It's not wrong, but you're merging two entries on 2 dates in one entry at one date. The two things did not happen at the same time.
Ah,
You received the cash during the year, and you're performing the adjusting entry at year end. So it's not wrong to do it like this. If they paid you 3,000, by the time they paid you, you already covered 30% and you're left with the 70%. That would be correct, but it's not practical to do it. It's not practical to happen like this, I mean.
okay. So,
Okay.
so we split like it's like two journal entries, huh?
Exactly. A journal entry and adjusting entry. Yes,
Okay.
you're right. You're merging them.
Okay.
Yes,
Thank
you're
you.
absolutely right.
Is it gonna be clear that we should take it from?
It is clear. Here it is clear. They are telling you the actual entry that was made, and you are asked to correct things. It is clear. That's what they did. The actual entry is what they did, which is wrong. So I want to go from what they did to what they should have done. Okay? Number 4. The accountant discovered that a 450 utility bill covering the month of December had not been entered in the account payable system at year end. What are we talking about here?
Accrued revenue.
Expense.
Accrued expense.
Utility expense. Utilities, electricity,
It's like
and
bills.
water. Yes.
Yes.
So this is easy because you don't have to correct an entry that was prepared. There was no entry prepared.
It's
So
only
let's
recorded.
do it. Exactly. Let's prepare it from scratch. So what's the entry? Debit the expense, credit the accounts
Debit.
payable.
Yes. 40.
Exactly. Debit the expense, credit the accounts payable. Great, great. Few more. Number 5. 4,000 of rent. Pay attention to this. I don't want you to make silly mistakes. Now do as much as you want. During preparation, do as much as you want. But in the exam, a silly mistake might be disastrous. $4,000 of rent was prepaid on 1/1/1, covering a 4-year rental period. So it's 1 month, it's 1,000 a year. No entry was recorded in year 2 related to this prepayment. So in year 1, this is what they did. They debited prepaid rent for 4,000, crediting cash. This is a correct entry, by the way. This is a journal entry that they did in year 1. No entry was recorded in year 2. So it seems they did what they need to do in year 1. In year 2, what shall we do?
In year 2, prepaid rent, debit prepaid expense, rent expense, credit prepaid rent.
I totally agree with you. Debit, rent expense, credit, prepaid rent. Actually, this is also the entry that they assume they prepared at the end of year 1, but they are asking for year 2. Actually, for year 3, we're going to do the same thing, and for year 4. Yes, who raised his hand?
It was me. I was gonna answer, but it's fine.
Great, Brahim. 6. Don't worry much about it. We're going to cover it in F3, the direct write-off method and the allowance method to estimating how much of your receivables will not be collected. So I will skip this because I'm not sure whether you remember what's the direct write-off method versus the allowance method. So I'm going to skip it. 7, that's interesting. Again, as a reminder about what do we mean by FOB shipping point. The company purchased 1,300 of raw materials at year end, which were shipped FOB, free on board, shipping point, and were in transit at the end of the year. the goods were not included in the actual year-end inventory count, the effect of this correction, blah, blah, blah. What do we mean by FOB shipping point? Do you remember?
It's still in the prom. It should be recorded in the books of the company.
Excellent, Brahim. Why?
Because that's the
Title
shipping
will
terms of shipping point.
exactly. What do we mean by FOB shipping point? It is the point at which you need to convert the title of the goods from the seller to the buyer. So FOB shipping point means once the goods are loaded on a common carrier, it becomes the purchaser's, although custody is still far away. They are in transit, but they are mine on my books because it's FOB shipping point. What's the other contract type? FOB destination point. Had this been FOB destination, nothing should have been recorded. Everything is correct. FOB shipping point means the title will be converted from the seller to the buyer at the destination point. Okay, so while they are in transit, they will be on the books of the seller if it is FOB destination. Here it's FOB shipping, so it should be on my books once they are loaded on a common carrier. So what would be the entry? I should debit raw materials, inventory, credit, accounts payable, notes payable, what have you. So if I'm using a perpetual system, debit inventory of raw material, otherwise I should have debited purchases. Again, don't worry much about this. I will be covering this in F3 next weekend. Again, available for sale securities, they should be reported on the balance sheet at their fair market value. So this is a violation to the cost principle, even under GAAP. Again, you will cover this, I don't know, in F4, F5. But you should recognize any unearned revenue, any unrealized gain or loss on your income statement if they are available for sale. But really, I will be wasting your time talking about available for sale trading or held to maturity at this point, because this will be covered in the financial accounting part, but in a different chapter. So I would again skip this. So these are the entries that we prepared together. And hooray, it is 9 o'clock. I'm done with the 3 modules I promised to cover. Any questions? I'm sure you're tired, you're depleted, but I'm still energetic. You're old, you're getting old. I'm still a young person. So if you need any questions, please ask. Give me some feedback. Are you okay with the way of delivery? Are you happy? Am I too fast? Do you want me to change anything for the remaining sessions?
I just
Because
have one
I'm going.
question, please.
Yes, sure, Sundus.
Thank you. Are we going to see the MCQs together?
Yes, yesterday, last week, and we did 3 MCQs together. Tomorrow we will do another 3 or 4. In every part, I will try my best to show you some MCQs, but you see the material, how loaded it is. We cannot spend much time doing MCQs. So I prefer to do some of everything rather than doing much of one thing and nothing from the rest. So the focus is on lecturing, some MCQs. Definitely, I promise tomorrow we'll see some MCQs. Tomorrow I will show you a video from a small, short video, 2-3 minutes, to remind you of the importance of seeing these videos that are available for you on Becker platform.
Given the
Okay,
simulation?
Usually I do not cover simulations because I can't find time for them, to be honest. But I would say the simulation, it is very important for the exam, definitely. But I think passing through 2-3 during your preparation would be great for you to set you in the ambience of the simulation. But me doing the simulation, I think I can assist you in different things and be more helpful in other things. I would assume you have simulations in the platform. You can do previous exams, including simulations. Of course, I will be responsible for answering anything. However, I think it is not of that added value doing it in class because I'm sure you can do it yourself. I mean, as to the mechanism of going back and forth in the simulation, it's friendly. The material, I assume I'm covering it through the lecturing and through the MCQs. But I know that no matter what I or anyone else will do, I will not be able to please fully everyone. So I'm sure.
I was just asking because if one has yani 40 questions in the MCQs, so I was thinking maybe if we could just yani take 20% if we could of the MCQs together, because I think they have some yani tips and how you can solve the problem. So maybe me and my
Sundus, to be honest with you, I've been teaching with Morgan. This is my 19th year. Solving more MCQ in class will please some candidates and will make other candidates say the instructor skipped a lot of the material. So he did not pass through the material. He skipped a topic or two. He skipped 40 slides. So while I try to please some, I may displease someone else. Now, what's best for you is to solve MCQs. But is it with me or by yourselves? This is, I think it is secondary. But definitely, this is your key to passing the exam, is to solve MCQs, thousands of them, multiple times. Now, this is why I selected to share with you some MCQs, either because they have some tricks or to show you good tactics that you may use in order to increase your chance to beat those MCQs. Other than that, sky is the limit, Sundus. And sorry if this does not agree with your expectations, but I cannot please everyone. Okay, Sundus. Any other questions? Feel free to ask. We will try to do more MCQs tomorrow as much as I can. I will try my best to select more MCQs on those tomorrow. So if you don't want anything from me, please feel free to leave the meeting. I will be the last one to leave in order to answer your questions. Good night. Have a remaining evening, nice evening, and see you tomorrow. Bye-bye.
Thank you for all.
يا هلا عبد الفتاح.
Can I ask you a question for application of revenue recognition long term? This material we will cover together.
Which one?
اللي هي applications of revenue recognition long term conservatings contracts.
Construction project.
Yes.
Construction project.
Construction contract.
Yes, we will be covering it. I think I thought it would be today. Let me check the slides if it is going to be tomorrow or in some other, probably in F3. Let me double check. Not in F2. No, it's not in F2, but I remember very well that I have covered it before, and I usually give F1, F2, F3. Let me check. From where are you getting the topic?
F2 from the book.
مظبوط
اوكي
دكتور، انا حتى شيكت في بكر
اوكي
وموجود في
اوكي
سكشن F2.
Probably you're right. Probably there is a slight difference between the slides I have, the old slides, and the new one. Yes, definitely we will be covering it tomorrow. I will recheck the slides that I missed and we will cover them. Thank you for bringing my attention to this.
Thank you. Thank you.
Anytime, anytime. Tomorrow, I promise you, tomorrow we will do it. That's a very
Okay.
important topic, by the way.
Yeah, thank you. Thank you.
يا هلا.
استاذ سمير، بس عندي سؤال صغير.
تفضل إبراهيم.
هلا بالام سي كيوز بصراحه في اسئله، سواء ام سي كيوز سواء تاسك بيست سيميوليشن، في اسئله يعني بتكون قديمه كتير وبتكون very complex. هل هاي الكومبلكسيتيز يعني should we really focus on them؟ يعني هل هيك اسئله حقك يجي؟
ما هيك إبراهيم، ما بسمح لحالي اقول لك لا، ما فيني اقول لك skip them. Becker usually they update their MCQs frequently, if I'm not mistaken. So if an MCQ is still popping up, I would say don't neglect it. Okay. Otherwise, you will end up focusing only on the easy ones. So I don't want to give you the visa to do this. Don't do it. If it's in the material, I would say give it what it needs to be grasped.
بس بتكون كتير صعبة، يعني مرة بعثت بصراحة.
ممكن اوقات انا شايف سم ام سي كيوز حتى بيكون فيهم توبكس منهم موجودين بالسكشن اللي انا معلمه، مثلا بيكون misplaced بمحل غلط، او ماتيريال كان فيها يعني تشابتر كان فيها الماتيريال وعاملين له ريشافلينج. but that would be the exception not the rule.
فهمت عليك، خلاص تمام. شكرا شكرا أستاذ سمير.
يا هلا، اهلا وسهلا فيك ابراهيم. يا هلا،
مع السلامة.
الله يحفظك. باي باي.